Hello everyone, it is Evan from the Trade Risk on Wednesday, September 2nd, here with a market recap video. We're going to analyze the current market environment, we're going to look at some other markets, and then look at some leading sectors. I'm pressed for time today, so it's going to be a little bit shorter. I'm not going to get into the individual names and trade ideas in this video. Most of the individual names are in similar formations that we usually look at. We've seen a lot of volatility. They're extended away from moving averages, and they're just not set up right now for some high probability swing setups anyhow. So I'll try and post some setups to the stream later this evening, but for now, let's jump into the action. We'll start with the SPY ETF, and today, of course, a nice session. The bulls came in gapping us higher today, and basically spent the day trying to catch their footing, digesting the gap up a little bit, and then ultimately seeing a nice rally into the close. We closed on the highs of the day, we closed above yesterday's highs, and we're proceeding to fill yesterday's gap. So we closed up almost 2% on the day, which is constructive. Now, I think this market still is a very difficult market to swing. Yesterday, for example, we gapped down 2%. Today, we gapped up 2%. We're still all over the place. The ranges are expanded. The moving averages are still racing lower. I would still consider this to be in bearish formation. The bears still have the ball, although, like I said to subscribers this morning, it's on the bulls to sort of prove themselves, and today they did prove themselves. I mean, they started to prove themselves. It's not enough for me to load up the boat on some long exposure here because I think it's still just not favorable enough, but it is a good first step here that we stopped the bleeding, that we didn't continue to roll over from yesterday's session. So that I think is constructive. So going forward, what I want to see is this gap get closed, and I think the really clear line in the sand is last week's highs, 190. Really, this should be back up here now, to 199.25. Getting back above last week's highs is just a great line in the sand. And again, I still think that's going to be trouble ahead. Look at all of the supply. As you remember back in these recaps, all we talked about was this boring range. Now all of that supply is above us, and that makes the long side of things, just much more difficult while we're still below this whole wall of supply up here that we traded, for 8 months out of this year. So that's sort of the landscape. That's the trouble. I still think you need to be cautious here. Still staying extremely late ourselves. Just picking our spots and just kind of watching the fireworks unfold. So I think that's it. On the downside, of course, is today's lows and then yesterday's lows. I think those are both levels that you need to watch. And I still believe the risk is still to the downside because these ranges are so wide. I think you just need to be careful. So that's my stance on the S&P 500. Let's look at the small caps. It's going to be very similar here, just different levels to work with. Again, the highs from last week, this whole area from 115 to the highs of last week, that's the line in the sand that you want to see us get above if you're in the bull camp. And then on the downside, you just want to see today's lows, yesterday's lows hold to prevent a further washout. But same scenario here, the fast moving averages still racing lower, need some time consolidating sideways, need some time for some of these charts to repair. If we go to the Qs, again, still continues to be the most constructive out of the bunch, up almost 3% today. It is above this round nice $100 level that held as the lows of the year and support back in January and February, so that is more constructive. It now needs to reclaim 105 to the highs of last week, so between this 105 and 106 area, if you're in the bull camp, you want to see that hold. Otherwise, you want to see this week's lows hold in the Qs. And again, that is definitely where some of the charts are healing up and firming up a little bit faster, and we'll talk about that when we look at some of the leading sectors later. First, let's talk about TLT. And suddenly, I was optimistic on this market for most of July, as we start to break out above this 119 level. But what I'm still eyeing on is last week's weekly bar. I think this is a very important bar, and until I see this negated, I think I definitely have sort of a cloud of pessimism over this market. I think that and it's not what I think, it's really what the market's telling us, right? And it's that this very bearish engulfing bar here, I think is very strong in this type of formation. So until I see that negated, I think the downside is probably something that is the path of least resistance until, again, we see some more sideways consolidation. We see that reversed. Otherwise, I think you probably want to be careful here on the long side in TLT. You know, the next first step would be getting back above 123.40. If we can get back above that, then of course the bulls have a chance at negating last week's damage. Let's look at USO. So this is a market I am long. I got long at not our classic sort of breakout trades on healthy charts, but I did like the bullish engulfing bar that we saw last week on some heavy volume. Actually almost engulfed the last 2 weeks. On the week so far, we're up 1.2%, so a nice little reversal today. Of course, yesterday, though, we reversed a lot of Monday's action. So that is a little confusing, so let me just recap that. Monday, we had a really nice igniting bar to start off this week. Tuesday gave most of that back. Today gave it all back and then proceeded to head lower until we saw that reversal, and we got this nice little reversal candle here. So basically what I want to see is I want to see these lows certainly hold from today, and I want to see us try to get traction here into the close of the week and hopefully close positive and start to add some gains to this. Again, it's still a market that is very damaged, but I'm willing to see if we can continue to push here a little bit. 1650 or so is a logical target. I would probably be scaling some off into that level. So that's my thoughts on USO. Long, but cautiously and calculatedly long. And UNG is actually another trade that I just got into today. We got into it towards the end of the day here. On a breakdown, I don't think I've ever really just had exposure to the energy sector, to the natural gas and oil. It's usually ones I don't trade that often, and I find myself in both of them now. I'm short this market. Clearly, you can see sort of the breakdown here of this range. You know, I think today, just looking at this, again, I'm not trying to predict anything, but this type of action tells me that, I mean, we're either going to see this just, it's either going to work or it's not, and it's going to happen fast. I mean, I should either be out of this trade or making profits tomorrow. It just seems like something that's not going to stay exactly where it is. This is either going to be a fake out and we're going to see a 3% gap up tomorrow and I'm just going to cover it for a loss, or we're going to just see this thing roll over pretty quick. That's at least my opinion, but we'll see what happens. I'm playing, of course, the breakdown here. This is essentially a new closing low minus this 1 day here back in Monday of April 27th. This would be the lows here for the year and 52-week lows, and you know, for the past several years for sure. So I'm short this market. Let's see if we can see continuation to the downside. Metals, they're sort of doing their thing. I like looking at the weekly chart nowadays because of how much movement some of these things have seen. Gold is up against this 110 level, this area, and it's going to be a difficult one for them, for the gold bulls to try and get above. But I think that's ultimately what needs to happen if they are going to get a little more constructive on this market. Still think it favors the bear side of things. Silver, same thing, favors the bear camp. It's just been a downtrend for multiple years now, and it's just tough to fight, and it's just messy. So again, don't see too much opportunity in this market just yet. Now let's look at some of those sectors. IBB, this is definitely where some of the strength lies. Just look at, you know, we only basically retraced this week with yesterday's gap down. We only retraced maybe 20% to the downside. So in other words, this impulse leg from 284 all the way to 353, we came down here and we only, you know, pulled back 20% off of last week's bounce. Of course, doesn't mean the week's not over, doesn't mean we can't continue lower, but if yesterday's lows hold as lows, this market relatively is holding up really nice. Again, fast moving averages still racing lower. It's not just out of the woods, easy long, but it is definitely a constructive market, and that's one that you probably want to focus on if you are sort of interested in the long side of this market. Industrials, similar situation. They're holding up pretty well today. They basically, again, they've already recovered yesterday's gap. The semiconductors, same thing. Gap from yesterday doesn't exist anymore, and even the technology sector holding up relatively well. The sectors to avoid, again, are still just the rate sensitive sectors. XLU, notice that we are below the lows from last week. So Monday's big fallout last week, we are now below that level in the utilities. So we've made a new low, which again just speaks to a sector to avoid. Same thing with the IYR, the real estate index fund here. We basically we retested the lows from last Monday yesterday, and holding up a little bit better than the utilities, but still underperforming relative to a lot of other sectors. And that's all I have for today. Hope you enjoyed the video. Hope you are out there managing risk, navigating this market fine, and I will try and get some trade setups up later tonight. Thanks for watching. I will catch you next time.